If silver cannot hold above $30 while inflation remains sticky and geopolitical tensions are rising, that is not random. It is a signal that something beneath the surface of this market is restraining price. Many investors expected silver to be at $35 already. Some predicted $40. A few still talk about $50 as inevitable. Yet here we are, hovering around the low 30s, grinding sideways while headlines scream about debt, deficits, wars, and currency instability. The real question is not why silver will move. The real question is why it hasn't moved yet. To understand this, we need to step back from emotion and examine structure. Silver is not just a precious metal, it is a hybrid asset, half monetary, half industrial. That dual identity is the first reason it behaves differently from gold. When inflation rises or financial stress increases, gold typically responds first. Gold is held by central banks. It is treated as a reserve asset. Silver is not. Silver trades more like a high beta extension of gold. It amplifies moves, but it rarely leads them. Right now, gold has already made significant moves relative to previous years. Silver, however, has lagged. The gold-to-silver ratio has remained elevated compared to long-term averages. Historically, that ratio compresses during strong precious metals bull cycles. A falling ratio means silver is outperforming gold. The fact that the ratio remains stubbornly high tells us capital is still favoring safety over leverage. Investors want protection, not volatility. The second constraint is monetary policy. Inflation is present, but the Federal Reserve has not declared victory nor signaled a full pivot into aggressive easing. Real rates remain positive. As long as short-term Treasury yields offer meaningful returns, some capital will prefer paper income over metal exposure. Silver thrives when real yields fall decisively, not when they are uncertain, not when markets are debating timing, but when liquidity is clearly expanding. Right now, liquidity is cautious. The dollar also plays a role. A firm dollar suppresses commodities priced in dollars. Even if global demand is stable, a stronger dollar mechanically pressures silver prices. We have not seen a sustained dollar breakdown. Without that, silver faces friction. But monetary policy alone does not explain the full picture. Industrial demand is often cited as silver's hidden strength. Solar panels, electronics, electric vehicles, medical equipment, silver is embedded in modern infrastructure. Demand from the solar sector in particular has surged in recent years. Structural green energy transitions suggest long-term consumption growth. However, industrial demand is sensitive to economic cycles. If global growth slows, manufacturing contracts, or China weakens further, industrial consumption expectations moderate. Markets price that risk ahead of time. So silver is caught between two forces. On one side, inflation and debt dynamics support monetary demand. On the other, growth uncertainty tempers industrial enthusiasm. That tension creates a holding pattern. Now let's talk about key price levels, because markets move around structure. $30 is psychological. It represents breakout territory from prior consolidation zones. Sustained acceptance above $30 signals accumulation. Failure below it signals hesitation. $35 is technical ignition. A decisive move above $35 would likely trigger momentum funds, algorithmic buying, and renewed retail attention. That is where narrative shifts from range-bound to breakout. $40 is where mainstream capital begins to pay attention. At $40, silver is no longer an underperformer. It becomes a story. $50 is historical memory. It is the 2011 high. It is also a psychological magnet. But markets do not move there without first clearing $35 and $40 with conviction. The fact that silver remains contained between $28 and $32 suggests neither buyers nor sellers have overwhelming dominance. That is not weakness, it is compression. Compression builds energy. Now let's consider three possibilities. First, the bullish scenario. In this path, inflation proves sticky while economic growth weakens. The Federal Reserve pivots from restrictive to accommodative policy faster than expected. Real yields fall sharply, the dollar weakens, gold makes new highs, pulling the gold-to-silver ratio lower. Silver breaks above $35 with volume. Industrial demand remains resilient due to green energy policy commitments. Investment flows accelerate into ETFs and physical holdings. Supply remains tight due to years of underinvestment in mining. In this environment, $40 becomes achievable. Momentum traders join. Retail sentiment returns. $50 becomes plausible over a multi-year horizon. Second, the neutral scenario. Inflation gradually declines without a severe recession. The Fed eases slowly but avoids aggressive stimulus. Real rates hover near zero. The dollar trades in a broad range. Industrial demand grows but at a moderated pace. Investment demand remains steady but not explosive. Silver fluctuates between $28 and $35 for an extended period, frustrating both bulls and bears. The gold-to-silver ratio compresses slightly but not dramatically. This scenario produces time correction rather than price correction. Silver digests gains and builds a longer base. Third, the bearish risk. Global growth contracts sharply. Industrial demand falls more than expected. The dollar strengthens as capital seeks safety. Real yields remain elevated due to persistent fiscal deficits requiring bond issuance. Liquidity tightens instead of loosens. In this environment, silver could retest the mid-20s, not because the long-term thesis collapses, but because cyclical pressure overwhelms narrative optimism. Notice something important. None of these scenarios are emotional. They are structural. Now let's address common investor mistakes. Many retail investors treat silver as an inevitable rocket. They assume monetary debasement automatically translates to immediate price explosions. They ignore timing. They underestimate liquidity cycles. They confuse long-term thesis with short-term price action. Smart money does not operate that way. Institutional capital watches positioning data. It monitors futures open interest. It evaluates real yield trajectories. It observes ETF inflows and outflows. It scales in during weakness, not after vertical spikes. If you look closely at the current environment, you do not see aggressive distribution. You see patience. You see range-bound accumulation. That does not guarantee upside, but it suggests informed participants are not abandoning the space. Another mistake investors make is focusing exclusively on supply deficit headlines. Yes, silver has faced structural supply constraints. Mine production growth has been limited. Recycling does not fully offset demand growth. But markets are forward-looking. If a deficit is widely known, it is partially priced in. The question becomes whether the deficit widens unexpectedly, not whether it exists. There is also leverage risk. Silver is volatile. It attracts leverage traders. When macro uncertainty rises, those leveraged positions are often reduced first. That creates temporary downward pressure even when fundamentals appear supportive. Volatility discourages large conservative capital from entering aggressively. Now we approach the critical turning point that many are overlooking: fiscal dominance. Governments globally are running substantial deficits. Debt levels relative to GDP are historically elevated. Servicing costs are rising. If bond markets begin demanding higher yields to absorb issuance, central banks may face pressure to intervene. Not for inflation control, but for financial stability. That is a different regime. If policy shifts from inflation fighting to debt management, liquidity conditions could change rapidly. In such a scenario, precious metals would not simply respond to CPI prints. They would respond to systemic credibility. However, we are not fully there yet. Markets are still debating whether inflation will normalize without crisis. They are still assuming policymakers retain control. As long as that belief persists, silver remains contained. Once confidence cracks, repricing can be swift. Another overlooked factor is volatility suppression in broader markets. Equity indices near highs reduce urgency for defensive assets. As long as risk assets remain stable, capital feels less pressure to hedge aggressively. Silver often accelerates when risk assets falter. So the real reason silver isn't moving yet is not weakness. It is equilibrium. Monetary uncertainty balanced by industrial ambiguity. Dollar strength balanced by fiscal fragility. Investor interest balanced by leverage caution. Markets do not move because of headlines alone. They move when positioning becomes misaligned with reality. Right now, positioning is cautious but not extreme. The gold-to-silver ratio has room to compress, but it has not begun collapsing. Real yields are not deeply negative. The dollar has not broken structurally. Industrial demand is strong but not exploding beyond expectations. This is a coiled spring without a trigger. The trigger could be a decisive Fed pivot. It could be a geopolitical escalation disrupting supply chains. It could be a bond market shock. Or it could be a sustained industrial boom that overwhelms supply forecasts. Until one of those forces becomes dominant, silver consolidates. Consolidation is uncomfortable because it tests conviction. It creates boredom. It shakes out weak hands. It conditions investors to expect nothing. Historically, prolonged periods of compression often precede significant expansion, but the expansion requires confirmation. Watch $30 for support integrity. Watch $35 for breakout validation. Watch the gold-to-silver ratio for leadership signals. Watch real yields and the dollar for liquidity shifts. Do not chase spikes. Do not panic on pullbacks within structure. Understand the regime. The disciplined approach is preparation, not prediction. If silver holds above $30 and macro liquidity loosens, positioning ahead of $35 makes strategic sense. If $35 fails repeatedly, patience is required. If silver breaks below the mid-20s under strong dollar conditions, reassess risk exposure rather than rationalizing losses. This is not a market for emotional reactions. It is a market for structural analysis. Silver will move, it always does. But it moves when the macro equation resolves in its favor, not when social media demands it. The investors who benefit most are rarely the loudest. They are the most patient. They accumulate when volatility compresses. They reduce leverage. They study liquidity. Right now, silver is not exploding because the macro regime is unresolved. That does not invalidate the long-term thesis. It simply means the timing window has not fully opened. When it does, the move will likely be decisive. Breaks above $35 would shift psychology. Sustained trade above $40 would confirm structural change. A challenge of $50 would represent a full re-rating of monetary risk. But until those levels are cleared with conviction, discipline matters more than excitement. Prepare capital, monitor macro signals, respect key levels, and avoid confusing consolidation with failure. If you value serious, structured financial analysis grounded in macro logic rather than hype, subscribe to this channel. Because when silver finally resolves this compression, you will want to understand not just that it moved, but why.